Hi, I'm Jen Snyder. I'm the president and founder of Doyen Corporation and Doyen Financial, and I'm here today with JP Laporte, who is the president of INTEGRIS Pension Management. We're here to talk today about PPP specifically for real estate agents who in some areas have been incorporated for some times and in some have just had that ability this year. So, JP, can you walk us through a little bit how we got here?
Yes, thanks, Jen. So, of course, the first thing to realize is that legally, in the legal world, the stars are starting to align. So, there have been a number of developments which have made it possible now for real estate agents that are incorporated to save for retirement using a pension plan. The first thing is that in 2011, my company, INTEGRIS Pension Management, introduced a personal pension plan, and that is the most advanced tax saving solutions under Canadian law. In early 2020, in Ontario, for example, and in other provinces at different dates, the legislature authorized real estate agents to incorporate using professional real estate corporations. And so now, thanks to the creation of these corporations, the real estate agent can start drawing a salary from their own corporation, and that allows them to participate in a pension plan. Finally, at the end of 2020, at least in Ontario, further legislation made it even better for people who wanted to set up pension plans. So if you set up a personal pension plan in Ontario, now you can have your plan exempted from all of the regulations that comes from the Pension Benefits Act. And depending on the province in which you're located, this may already be in place. So for all of you that are real estate agents that now have the right to incorporate, depending on the province in which you're located, you may be able to set up a PPP with very few restrictions. And in 2021,
sorry, go ahead.
In 2021, we were able to structure PPPs in a way that they can invest in private real estate opportunities on a pooled basis. So you'll see, we'll have some slides on that, but this is another great development in the law that is very recent.
So, if I can just jump in for a second, because you said something really interesting about once you have a corporation, you're able to pay yourself a salary. And that's really important because I know most real estate agents don't actually do that. Even if they are incorporated, they may not necessarily pay themselves a salary. And so that is crucial in this particular area, isn't it?
Oh yeah, this is the most important point, is that if you refuse to take any salary out of your corporation, if you only believe in paying dividends to yourself, then you're completely ineligible for a pension plan of any kind, let alone a personal pension plan. So all of the great stuff we're going to be talking about become impossible. So it is critical that if you are incorporated and you are deciding to draw money from your corporation, that some of it, doesn't have to be all of it, but some of it has to be in the form of a salary.
It doesn't hurt to, like, from a financial planning perspective or just from a wealth creation standpoint, to be able to put these things in place so that you can achieve, greater wealth over time.
Yeah. So with respect to going back to this slide here, what are the consequences of these stars aligning? Well, from a personal tax point of view, we can go from a top personal marginal rate in Ontario of 53.5%, and it's pretty consistent across the country. If you're not incorporated, if you're taking all those commissions personally, you can drop to 12.2% in Ontario. I think it's 9% in Manitoba, and it depends on the province in which you are, but you can dramatically reduce the tax bite by having those commissions taxed within the corporation instead of personally on your personal tax return. So in the first $500,000 of commissions, right away, dropping from a 53% tax rate to a, let's say 12.2 or 10% or 9% is quite significant.
I'd say so.
And because you are taking a salary, those salaries will create more tax deductions for the corporation, of course. But now the salary gives you the right to set up a PPP. And that PPP doesn't have to be offered to anyone else. It could just be you as the real estate agent. So now, if you decide to set up a PPP and the corporation starts making contributions to the PPP, instead of paying 12.2% or maybe more if your corporation has much higher taxable income, the effective rate of the corporation would be zero. It'd be a full deferral on those contributions made to the PPP by the corporation. And the reason why that is because just like the payment of a salary, the contributions made by the professional real estate corporation to the PPP are fully tax deductible under the Income Tax Act. So we went from a situation where you were taking your commissions personally and paying over half to paying nothing and deferring that tax inside of a tax sheltered pension plan.
That's huge.
That's a nice start.
Yeah, I should say.
But then it's not just that, it's that those commissions, let's call it the commission, the cash that the professional real estate corporation earned that didn't pay tax on it because it contributed those commissions to the PPP and therefore got an offsetting tax deduction. The growth on those assets is also tax exempt because that money is now growing within a registered pension plan. So the next question is, okay, I'd like to have my money grow tax free or tax deferred, but can it be in real estate? Because that's the only asset class that I truly believe in, or that's the only one that I truly understand really well, because that's what I do day in and day out as an agent. Well, if you wanted to invest in private real estate in a non-registered account, you could, possible. Unfortunately, the growth is not tax exempt. Every time you invest in real estate and you make money, you have to pay tax on that growth if you're in a non-registered account. Can you do it in an RSP account? Well, very, very, very difficult because the banks and the custodians will say, no, we don't, these accounts, these RSPs are for stocks and bonds traded on the stock market and the public markets. You can't open up an RSP and then walk down the street and say, I'd like to buy this triplex with my RSP. It's extremely complicated, convoluted, costly, and difficult, if at all possible. So it depends on the financial institution you're dealing with to do this. But if you have a PPP, not only can you invest in that asset class, the growth can also be tax exempt. That's a big difference. Now, you might say, well, hey, real estate is going up and up. It's going to require a lot of money in order for us to buy some meaningful real estate. And as much money as I might put in my own personal pension plan, that just won't be enough to make a down payment or two to buy some real estate. So now we have, and this was the last point I was making at the very beginning of the presentation, in terms of the stars aligning, we can pool PPPs together to create our own real estate acquisition bank, for lack of a better term, where we are pooling monies that are tax exempt, that people have put in their own PPPs, and we go and buy some real estate together as a group. So, for example, each agent in a brokerage firm could set up their own PPP and invest as they see fit, right? Stocks, bonds, GICs, mutual funds, whatever. But some of those, or all of them, could buy or purchase shares of what we call a private real estate pension holding corporation. So this is a creature of the Income Tax Act that says that because the shareholders are all pension plans, the corporation is tax exempt and it must invest in real estate. So these PREPHC is tax exempt because all the shareholders are tax exempt registered pension plans.
And so for those people that might be saying, you know what, this sounds too good to be true. You know, the idea just reducing the amount of tax that I pay on real estate, being able to pool together all those things sounds too good to be true. But there's number one, it's in the Income Tax Act. Is that true? And also, and also there's other examples like OMERS or those kinds of plans that already invest in real estate.
Oh yeah. Registered pension plans, which is what a PPP is, except a small one, have been investing in real estate for decades, for 40, 50, 60 years. This is allowed by tax laws. That's why in Ontario, the 407 highway, the toll highway north of Toronto, is owned by a pension plan.
Right.
Right? So this is nothing, there's nothing special about it. That's just the way the law works. All we did is say, hey, if we can do it for a multi-billion-dollar pension plan, why can't we do it for a much smaller plan with just a few $1,000,000 in it, or even less than that?
Absolutely.
So let's look at a quick example. Imagine that we have a brokerage firm with, let's say, 4 real estate agents, John, Julie, Sunil, and Don. And these 4 agents want to save for retirement. They don't want to pay 53.5% tax personally. They'd rather pay in Manitoba 9% tax corporately, or in Ontario 12.2% tax corporately. So they set up these professional real estate corporations, which are the rectangles. But now, because they're taking salary out of their corporations, each agent is able to set up their own PPP. So they're not mixing their money. Now, it just happens that John doesn't believe in real estate for some reason, even though he's a real estate agent. As an investment, he wants to do something else, so he's not going to participate. But Julie, Sunil, and Don, they want to invest in private real estate. They want to buy an executive home that they can rent on Airbnb. They want to buy a couple of townhomes in a up-and-coming area, or they want to do a build, renovate, and resell and flip it. So what they do is that each PPP that's tax exempt buys shares of a real estate pension corp. The one that we were talking about earlier, that one is tax exempt. And now that company, we set up a bank account for it, it becomes the landlord of the underlying private real estate as an investment. So when it collects rents from the tenants, or when it pockets a check when it sells the property to a new buyer, and there's a capital gain, none of that is taxable. It just stays as untaxed income inside of the real estate pension corp. And obviously, the real estate pension corp could always pay dividends back up to its shareholders, the 3 PPPs. And those dividends would also be tax exempt because the PPPs are tax exempt. So you see how we're now able to invest in an asset class without having to pay tax along the way. And by pooling a bunch of PPPs, now we're developing sufficient capital to do meaningful acquisitions. This would not really work if Julie was by herself and she wanted to do real estate. We could do, but it wouldn't be something that she controls.
Well, and that's what happens. That's what stops so many people from investing in real estate, especially in expensive markets, right? Or for larger projects. They just don't have the funds, and so they end up trying to save the money, but they just can't get there on their own.
Yep. So this Pension Real Estate Corporation is a tax exempt entity. We've already talked about that. That's baked into the Income Tax Act. When it sells the real estate, or if it's facing a capital gains, it can ignore it because it's tax exempt. And then it can redeploy that cash that it earned to buy other properties and repeat the process. Or it could repatriate some of those profits in the form of dividends. Again, those are tax-free because the shareholder is a pension plan. So that the pension plan can invest in something else than real estate. So we're able to do some diversification if need be.
Right.
But we don't have to.
Always a good idea.
So just to recap, by using this strategy, the personal tax rate that normally you would have to pay personally at 53.5% or lower or high, depending on where you are in the country, can drop to say 20% or 21% in Quebec, 12.2 in Ontario, 9 in Manitoba on the first $500,000. But if you use the PPP, then really you don't even pay that tax. It goes down to zero because it's fully tax sheltered. And the growth of those assets that have been contributed to the PPP in real estate is done without any taxation. And if one PPP just can't pool enough money to go into real estate, then by banding together a bunch of PPPs, we can generate the economies of scale and the capital to really do some real meaningful real estate acquisitions. So that's really all I wanted to say, Jen. Do you have any questions?
Well, I know the first question that anybody would ask is the first question that I had too is, can I do this for my own home?
No. So one of the rules of pension investing is that you're not supposed to do what are called either prohibited or related party transactions. So prohibited is when you recycle your own pension money to buy shares of your own company, right? Or to buy shares of your spouse's company or your kids' companies. These are all related parties. And therefore, the government doesn't want self-dealing. They allow you to invest, but it has to be a third party at arm's length, where you've done your due diligence and it's a prudent investment. So long as you're dealing with third parties, you can buy whatever real estate you want, but you can't recycle your own money.
Right. So investment in real estate or investment properties, that's what we're really talking about here.
Yeah.
Excellent. And then, of course, the next thing is, how does this how does this work for me personally? How do we get started?
Well, to get started, the first thing you do is get an illustration done to make sure that the PPP works in your particular circumstances. So you go to Doyen and then they would collect information about your salary that you're pulling out of the company, whether you might have paid salaries in previous years, whether you have any RSP room, whether you have any RSP assets. And then we'd get an actuarial valuation done, an illustration that would allow us to quantify what are all the annual contributions that are permitted under the PPP. And then it would also compare that to what's possible under an RRSP. So you have a side-by-side comparison of the two strategies. And then you tally up all the advantages, you subtract the fees, and then you get your net advantage. And if that advantage is significant, then that's usually a green light to move forward with implementation.
Absolutely. I guess one of the other questions would be, my spouse and I work together on the real estate. Maybe one's an agent, one isn't. Can you have the PPP for both of them if they're working for that company, or is it just the one?
Yeah, so participation in the PPP isn't dependent on whether you're a shareholder or not. It's only the only thing that matters is whether or not the professional real estate corporation is paying you a salary. So, or bonus, anything that's T4. So long as the professional real estate corporation is paying T4 to either one of the spouses in the couple, they can join the plan, whether they're shareholder or not.
And is there any advantage from, I mean, because the big problem or that some people face with the RSPs is, when one spouse passes, the other one gets the RSP, which is great. But when the second spouse passes, then you've got a problem on your hands. It's a fully taxable situation. So if we've crammed a bunch of money into these PPPs, what happens on death?
Well, if you happen to have children and you're able to put the children on the payroll of the professional real estate corporation, then you have magic that occurs. I'm saying magic, but it's not really magic. What happens is if the children are members of the plan and the parents pass away, you're talking on second death, all the money that the parents left behind because they didn't spend it all becomes pension surplus. And because the children are also members of the plan, they get all that surplus without paying any tax. There is no deemed disposition, the way there is with an RRSP or a RIF. Under a PPP, when the children are members of the plan and the parents pass away, there is no deemed disposition. So instead of giving half the money to the government, you're keeping it in the family for use by the children that survived. So that's a huge tax planning opportunity that virtually nobody in the country seems to know about.
Right.
So
And
that's, yeah.
Sorry, go ahead.
No, that's all I wanted to say on that point.
Well, and you just think about that for a second. Let's say that you've amassed, a portfolio of different properties, whether it's on your own or in conjunction with other people. Being able to pass that from one generation to another in a tax exempt and completely legal way is amazing.
Yeah, it's very powerful stuff. I mean, I had one client in Alberta who had $8 million in his plan, and it was the only plan member. So our recommendation to him was, since his children were on the payroll, they should be added as members. And at first, the client didn't really understand why. So when we explained and said, well, listen, if you pass away, given that you don't have a spouse and you can't do a rollover to your spouse, normally your 8 million would transform into 4 million because 4 million would go to the government. But now, because your children are members of the plan, the 8 million will just become surplus and your children will have access to the full 8 million. And if they don't pull any money out, it will become 10 million and 12 million and 15 million. And they will only pay tax when they pull money out of the plan, whether it's in the form of a pension or a pension with a little bit of surplus.
Right. Yeah, and that's important to keep in mind is that this is just like RSPs were before this was available to us. The whole idea here is to be able to provide you with a retirement asset in addition to being able to buy real estate. Like it really is, the intention is to be able to pay you a pension.
Yeah, and one of the things, maybe you were going to ask me this one, but one of the great things also is going back to my friend client that with his $8 million in his pension plan, if he ever crossed the border and became a non-resident of Canada, normally we have under the Income Tax Act a departure tax, a deemed disposition on all of your worldly goods in Canada, except if you have what are called exempt assets. Well, it turns out that the PPP is an exempt asset. So the full 8 million doesn't get taxed. So that's saving that family another $4 million. So we saved the kid $4 million on death, and we saved Them again, another $4 million if they became non-resident. We're up to $8 million in tax savings. So it's pretty powerful stuff.
Absolutely. So the slide that we have here has some QR codes. The top left one will bring you to the Doyen site. The bottom right one will bring you to the INTEGRIS site. You can reach out to me at doyen.ca. There's about 10 different ways that you can reach me if you're interested in talking about PPPs and what it could mean for you. JP, I just, it's a mind blown kind of situation. Every time we talk about these PPPs and I think about just how powerful a tool this could be for people, it's really, really a powerful thing.
Well, what's also nice is it's been in part of the income tax legislation all the way back to the stuff on pensions, goes all the way back to the very first Income Tax Act in 1917.
Yes.
The one that was used to finance the First World War. So this is not some crazy tax stuff that's brand new, and it's just that no one until recently put it all together under this package.
Yeah, that's important to note because, you know, the people will always say or question, you know, what about, you know, the whims of the government? This is something different than that. This sits above, well, not above them, but it has existed throughout different governments.
Yep. And it's all government regulated, government approved, government sanctioned. This is the same rules that the large pension plans in the country have been following for decades, for over a century. It's just that it's just applied to the level of a tiny, tiny corporation, you know, namely here, the Professional Real Estate Corporation. But the
Yeah,
law has,
finally we get to take advantage of that.
exactly.
That's fantastic. Thank you so much for sharing this with all of us. And as I said, if anybody wants to know more about the PPPs, give us a holler.
Bye-bye.